Josh Stanley here at the Heritage Wealth Planning YouTube channel. Got my subscribe shirt on, so just make sure you subscribe here today if you would. Hey, I just did a video on borrowing against your TSP, and I've done other videos on borrowing against your 401k as well. And I just want to go over the reasons why you want to do these things, because I just find it, the financial planning area, I tell you, they just blow this up all the time. Say, no one should ever borrow against your 401k. You're stupid to do something. You know what? It's sometimes it's right, sometimes it's wrong. But man, it's okay, first of all, to consider borrowing against your 401k, your TSP, and if you have a 403b and they allow you to borrow, that's fine. But let's go over the arguments why, what we hear all the time, why you don't, and then I'll debate those arguments just with myself, I guess. All right, so one of the things that you hear, so just remember, a 401k, a 403b, again, they may or may not have the borrowing opportunity. A TSP, a thrift savings plan, these are all what's called qualified retirement accounts. All right, you get them through an employer-sponsored plan. You work for, I don't know, we got Verizon behind me. You work for Verizon. You put in X amount of dollars, they match you. The money you put in is tax deferred unless you do the Roth 401k, which you should do. And I have a video on that. But let's just say the money you put in is tax deferred. You got $100,000 in there. You've never paid tax on it. And you look over your shoulder and you have these other credit card debt, car loan, maybe a home equity loan or something like that. And you're like thinking, I got all these little debts and I don't want to have debt. And I have this equity right here. Should I borrow against my plan? And again, it's a TSP, 401k, or 403b in order to pay off these debts. Now, you can't borrow against an IRA. It doesn't work like that. You can take a distribution now as long as you put the money back in within 60 days. And I don't advocate doing that. But in theory, you could do that for sure. It's not a loan, but don't do that. Roth, you can always take your principal out at any time of your Roth IRA. It doesn't matter when, where, how. If you have $100,000 in a Roth, of which you contributed $20,000, you could take that $20,000 out right now if you want, without question. That's not debatable. It's not taxed, not penalized. But generally speaking, a lot of people don't have that much in a Roth, and a lot of times they have a lot more debt. And so what we want to do is find a way to manipulate your equity to pay off your debt. So remember, your net worth is simply everything you own minus everything you owe. So if I have $100,000 in total ownership of stuff, and I owe $50,000, I have a $50,000 net worth. Now, how do we get this $50,000 to drop, and how do we get this to increase? And that's where some just borrowing against your 401k can come in and be a good mechanism to do that. So, or your TSP. So the argument I get all the time is you shouldn't do that because you're taking money out of the markets, and in that way you're not going to get the growth that you could. And so the area, and that, inherently that makes sense. If I think I'm getting 6 or 7% of the money in the market, and I'm only getting, let's say, 3% on my borrowing, then I'm going to lose that potential 6, 7, 8% in the growth in the market. And that inherently makes sense. Absolutely. I completely agree. If I knew for a fact I was getting 8% over here versus 3% over there, then that argument would be 100% solid. Now, the problem with that, of course, is we don't know what the market's going to give us. We have no clue, but we know for a fact our interest over here is costing us 6 or 7%. So we know that for a fact is costing us 6 or 7% in borrowing costs for our credit card, or mortgage, or a car loan, and all that. Whatever the interest rate is cost. If that interest rate is costing me similar to what I'm getting on my investment returns, then you should borrow against your 401k or TSP, because the borrowing costs are flat, and they're guaranteed. My investment returns are not flat, and they're not guaranteed. I could actually lose money. I could make more. I could lose, could make more. At the end of the day, we don't know. All I know is the borrowing costs are fixed, and they're guaranteed each and every year. The interest, the rate of return I'm getting on my investments are not fixed, and they are not guaranteed. So they could actually drop in value. So that's part one of that conversation, is that yes, in theory, I could do better on my 401k if I leave it in the market than if I borrowed against it. The second part of that is when you're borrowing against your 401k, you're actually paying yourself the money. All right. So I just did a thing on the TSP thrift savings plan where it costs them 2.85 is the interest. So they took $50,000 out. After end of 5 years, they're going to have $53,000 in that account. that $3,000 of interest they've accumulated goes to their account. It does not go to the bank. It goes to them. All right, so they're guaranteed to make that $3,000 because it's based on the yield of the 10-year treasury. Actually, in this case, it's the G fund. Whereas, so now not only am I not paying the bank that 6 or 7% interest, but I'm paying myself that 3% interest. So that's a net win, 2 wins there. Now the argument would be, yeah, but you could have got 6% or 8% or 10% of the market as opposed to 2.85 you're getting on your own. Well, yeah, I get that. But if that's the case, then why doesn't everyone have any equity in their home? Shouldn't everyone in that case borrow 100% of the equity in their home because their home is only going to grow in value, say 3 or 4%, and the mortgage is only costing you 4% tax deductible, but the rate of return I can get in the market should be double or even triple that, right? So for someone to advocate that I don't want to borrow against my TSP or 401k because I'm only going to get 3% over here, and in theory I could get 9-10% in the market, and certainly don't want to borrow against it to pay off a debt that I'm paying 6 or 7% when I can be getting 9 or 10% in the market. The number one question you ask is, well, why do you have any equity? I mean, in theory, that makes complete sense on paper. Don't pay off your mortgage. Don't pay off your debt because the mortgage interest is cheaper, it's deductible, and I can get a lot better income growth potential in the stock market or the investment market. Well, then don't have any equity. No one should have any equity whatsoever. And yet when you say it like that, people are like, well, okay, then your argument is not valid in that regard. It's just not a valid argument to say I should not borrow against my 401k to pay off a lower interest debt. At the same time, I have equity in my home. I hope that makes sense because that drives me up the wall. Like, oh, I can get better. I should never pay off my mortgage. The same argument as that. I should never pay off my mortgage because it only costs me 4% of my mortgage and I'm getting a deduction. So let's say it nets me 3% and I'm getting 9-10% of the market. Okay, then I want to see your mortgage statement and I want to see your loan value, and you shouldn't have any equity in there. Your loan to value should be 100%, and it never is. All right, number 2, and this one drives me up the wall too. Oh, but if you borrow against your 401k, you got to pay it back after tax. Yes, it is after tax because the proceeds I took from the borrowing comes out tax-free. So I put that money into the 401k or TSP to begin with. I paid no tax on it. That is 100% correct. I got a tax deduction. Essentially, it did not flow to my gross income. It was not there. So I went in tax-free. It comes out tax-free as a loan. Yes, I have to put the money back in after tax. 100% right. That's right. I don't get a deduction on the fact that I already got a deduction. And yes, the money is going to come out taxable later on. That's simply just a wash. I never understood why this doesn't make any sense to me. I put the money in tax deferred, all right, which only means I'm going to pay tax on it at some point. So I put it in tax deferred. I will pay tax at some point. I'm taking the money out tax-free via a loan. The money going in after tax. And I'm still getting to pay tax on that money later on down the future. I mean, it's just, people make a huge issue that you're paying after tax money on something you're going to have to pay tax on later on. But you took the proceeds out tax-free. I mean, literally, you could take those proceeds if you want. And I mean, you can slip them up your nose. You can do whatever you want. You're not paying tax on it. So the idea you got to pay tax on the money going in when you already got access to the money tax-free, I don't get it. I mean, again, put the money in tax deferred, you're paying tax on the distribution. All I'm doing now is I put the money in tax deferred. I took a distribution out tax free. I'm paying after tax on the payments for that tax free distribution, and I'm going to pay tax on the distribution. That's all we're doing. It's just another step in the line there. Right? People make a huge issue about that. The other one, and this is a big one. If you don't expect to stay employed at your employer for 5 years, any account balance that's outstanding. So if you borrowed $50 and you still got $30,000 outstanding, you're going to pay income tax and a penalty if you're under the age of 59 and a half. That's true. I mean, that's a fact. So if you have an account balance outstanding, you will pay income tax and you will pay a 10% distribution if you're under 59 and a half. So if you're considering borrowing against your 401k, just make sure you do so under the auspices that you really need to be staying at the employer for 5 years. Now, let me tell you like this. So let's just say you quit your job on January 8th. and you're not expecting to have any income for that next year because you're going to go start a business or something like that. All right. So, I mean, you don't have hardly any income tax because you have no income. Now, you're still going to have to pay that 10% penalty. Would that be offset by standard deductions? I mean, at the end of the day, it's not the worst thing ever happened, especially if you're in a low income tax bracket because you quit a job to do something else, maybe go to school. I don't know. At the end of the day, the 10% you're not going to get around, but the income tax in of itself, depending on how you quit the job to maybe to go, like I said, to school or something like that, it probably won't be a huge issue at all. Now, it could be. I mean, don't get me wrong. That could be. All right. So we have the 401k money can grow. You're paying your loan back to yourself. I mean, the 401k money, there's three things there. We got if you quit before 5 years, the money that you're getting in the 401k goes in after tax, even though you took out the tax-free, it came out tax-free. And again, I don't get that. And you're not going to have as much growth on the money because theoretically the stock market could do better than the loan that you're paying yourself. All those three things can be debatable. The big one, frankly, is at the end of the day, if you think you're going to leave your job early, or if you think the market is going to do well. So if you think the market, because Obama was elected or Trump was elected, is going to take off, yeah, I mean, at the end of the day, you don't want to have $10,000 sitting over here drawing 3% of interest to yourself while the market's up 20%. That inherently, that doesn't make any sense. That's a big gamble, though, for sure, because we know for a fact that the markets tank every couple of years. That's just factual. Now, unfortunately, it's completely random. It doesn't go up, 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 down, up, 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 down. It's completely random. Sometimes it goes down, down, up, down, down again. We just don't know. So it's always a risk, and that's just a risk reward of the market investing anyway. You're saying at the end of the day, I can do something with my money today, or I can defer doing something with my money, and hopefully I get a good rate of return in the equity markets, equities being stocks. So anyway, I just want to say all these people get all caught up. Oh, and don't forget, by the way, you actually increase your net worth if you have a loan that is, like 6 or 7%. I've actually done, or 10%. I mean, if you have a credit card or a loan that costs you a certain rate of return, borrowing against your 401k actually increases your net worth, my friends. I don't know. A lot of people don't get that. You actually improve your net worth because you're taking a 10% loan, wiping it off the mat, and giving yourself a 3% rate of return. So that's a 13% difference there. Not only am I not paying you, Mr. Banker, 10%, but I'm also banking on 3% to myself. And so that's a big deal as well when it comes to borrowing against your 401k. I'm actually getting a decent rate of return. Again, decent is relatively speaking. It's all going to be based on your situation. Also, when it comes to 401k, the company that you use will have a loan fee, and the TSP was $50. I used to work at USAA. It's $150. Seems like I'm missing something else I wanted to talk about. I just thought about it too, and I'm drawing a blank. So we have the 401k, the loan, the proceeds are tax-free. You pay it back with after-tax money. Yeah, I can't remember. I'm drawing a blank too, and I had just written it down. The loan, the amount that's outstanding, you got to pay within 5 years. The most you can borrow is $50,000 or half of your equity, whatever is less. So that's the most you can borrow. The proceeds tax-free. Oh, so just remember too, on the 401k loan, you can always pay it back early too, by the way. So if you get a certain amount of money that comes in quickly, you can contact your employer, say, I want to pay this off, and it'll do that for you. So if you get like big bonuses or something like that, you should definitely do that as well. All right, well, that's it. There's one thing I'm missing. I might jump back on here to talk about that, but for right now, I can't remember what it is. So hope this helps. Don't forget to subscribe down below. If you do subscribe, hit the little bell to be notified for future content. Thumbs up, comments are always welcome. If you disagree with me, that's fine for sure. Man, I'm just drawing a blank on that one other thing I had. I should have written it down, but I thought I remembered it. I did just remember it. Now I forgot what it was because it's critical. Yeah, I tell you what, hold on just a second. I wonder if I can go here. Tell you what I'm going to do. I think I can switch out to go to, can I do that? No. There was a way you could go back to your channel where you could do a screenshot, but I don't know how to do that anymore. All right, my friends. Well, I'm going to call that one then. I'm thinking, drawing a blank what that last one was. All right. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys. Actually, I wonder if I do this. Hold on a second, my friends. I'm going to try doing this. What happens when I'm doing this? I don't know. Are you guys seeing my screen? So I'm going to go to YouTube. We're going to go to my channel here. I'm not sure if you're seeing this or not. TSP loan. I'm going to show you exactly what I just did. If y'all can see this or not, I do not know. Come on, man. So this is going to be sitting in my craw about what I was thinking. The last thing on my 401k. As you get older, my friends, you forget stuff. All right, so let's see. Because I had written it down here. I should have just wrote down my notes, but I didn't. All right, so let's pause this guy right here. Bear with me just a second. And we're going to talk about the monthly payments, $850 borrowing. Here we go. Oh, yes, that's it. The interest. Phew. A lot of people think, but Josh, if I borrow against my 401k to pay off my home equity loan, I lose the interest deduction. Hey, do you? I mean, if you're not itemizing, you're not losing an interest deduction because you're not taking the interest deduction as it is. And don't forget, if you're married filing jointly, under the new Trump tax bill, you got $24,000 of interest deductions, which means you have to have more than $24,000 of interest of deductions in order to itemize. So let's just say you do. Let's say you have $26,000 of total interest, not interest, but total deductions. So you don't itemize, you don't take the standard deduction. You itemize because you have 26,000 of itemization deductions and 24,000 of standard deductions. All right, well, you already get 24,000 for free. So the only amount of interest that you're truly deducting is $2,000. If it costs you $8,000 in mortgage interest, you're only deducting $2,000 of that. And by the way, don't forget, you're only deducting it off your tax rate anyway. So if your tax rate's at 10% and you're only able to deduct $2,000, that means you're only saving $200 in tax. So if you're saving $200 in tax and it's costing you $6,500 net, that's not a good win, especially when I can pay myself, not only not pay the $6,500, but pay myself $2,000 in interest. Does that make sense? So if a lot of people say, well, you get to itemize, you get to do deduction on mortgage interest, and you don't get that on the TSP. It's even better because the TSP, you're literally paying yourself the interest back. That's 100% going back to your pocket. Taking the mortgage interest deduction, let's just say your rate is 4%. Even if you could deduct 25% of that, you're still paying a 3% rate of return, which is still even higher than what you're paying yourself in the TSP loan. And that's only if you mortgaged it, if you only able to itemize. And even if you're just right there on the cusp of $25,000, you're not deducting the entirety of that mortgage interest. You're deducting just a little bit above the $24,000 threshold. So anyway, just don't get caught up in the mortgage interest deduction. I cannot stand that. I hate when I hear, I need a mortgage so I can deduct. That doesn't make any sense at all. I don't get that in the least. So don't fall for that. Anyway, hope this helps. So that was it. We'll see you guys next time. Thanks, guys.